Forex trading can be exciting. The thrill of making a successful trade can be exhilarating, and the potential for profit is what draws many people to this market. However, it can also be incredibly risky. The market is unpredictable, and without proper knowledge and preparation, you can quickly find yourself in a difficult situation. In Forex trading, you buy and sell currencies with the aim of making a profit. This requires not only skill, but also a deep understanding of market trends and movements. The market moves up and down frequently, a phenomenon known as volatility. This volatility can create opportunities, but also poses significant risks. Without a well-thought-out plan, you are essentially guessing. This can lead to poor decisions and potential losses. A good Forex strategy is crucial. It helps you make informed and smart choices, guiding you through the complexities of the market. Your strategy tells you when to buy and when to sell, helping you to maximize your profits and minimize your losses. Think of your strategy like a roadmap. Just as a roadmap guides you to your destination, a well-crafted strategy guides your trading decisions. A roadmap helps you reach your destination efficiently and safely. Similarly, a Forex strategy helps you achieve your trading goals. With a solid Forex strategy, you can navigate the market with confidence, reach your trading goals, and celebrate your successes. There are many Forex strategies out there, each with its own unique approach and methodology. Some strategies are simple and easy to understand, while others are more complex and require a deeper understanding of the market. Today, let's focus on a simple yet popular strategy known as the simple moving average crossover. This strategy is widely used by traders of all levels. So, what exactly is a moving average? A moving average is essentially the average price of a currency pair over a specific period of time. It helps to smooth out the price data to create a single flowing line. By smoothing out the price changes, moving averages make it easier to identify the overall direction of the market. This smoothing effect helps traders to see the trend more clearly, which is crucial for making informed trading decisions. The simple moving average crossover strategy uses two different moving averages: a short-term moving average, such as the 50-day moving average, and a long-term moving average, like the 200-day moving average. Here's how it works. A buy signal is generated when the short-term moving average crosses above the long-term moving average. This indicates a potential upward trend. Conversely, a sell signal occurs when the short-term moving average crosses below the long-term moving average. This suggests a potential downward trend. By following these signals, traders can make more informed decisions about when to enter or exit trades. Let's say you are watching the EUR-USD currency pair. This pair is one of the most traded in the Forex market, known for its liquidity and volatility. You are using the 50-day and 200-day moving averages. These moving averages help smooth out price action and identify trends over different time frames. You see the 50-day moving average cross above the 200-day moving average. This crossover is often referred to as a golden cross, indicating a potential upward trend. This is a buy signal. You buy the EUR-USD. Entering the trade at this point can be advantageous, as it suggests the beginning of a bullish trend. The price goes up, and the 50-day moving average stays above the 200-day moving average. This confirms the strength of the upward trend. You stay in the trade. Monitoring the trade is crucial to ensure that the trend continues and to make adjustments if necessary. Later, the 50-day moving average crosses below the 200-day moving average. This crossover is known as a death cross, signaling a potential downward trend. This is a sell signal. You sell the EUR-USD. Exiting the trade at this point helps to lock in profits or minimize losses. Remember, past performance is not an indicator of future results. Always conduct thorough research and consider multiple factors before making trading decisions. Section 4. Keep learning and growing. This is just one example of a Forex strategy. There are many others. It's important to find one that suits your risk tolerance and trading style. Don't be afraid to experiment and test different strategies. Use a demo account to practice before risking real money. Education is key in Forex trading. There are many resources available online and offline. Books, courses, and websites can teach you more. Section 5. Your next trade awaits. Forex trading can be rewarding, but it takes time and effort to succeed. Start by developing a solid trading plan. Learn about different strategies and find one that works for you. Manage your risk and always be learning. The world of Forex is waiting for you. Take the first step towards your trading journey today. Section 6. Want to dive deeper? This is just the beginning of your Forex adventure. There's so much more to explore, like this post if you found it helpful. Share it with your friends who are interested in trading. Follow me for more Forex tips, strategies, and insights. Let's master the art of Forex trading together.